Good morning, everybody. Thank you all for jumping on. This is Jess Riley, Director of Life Sales here at IAMS. We're going to give just a couple more minutes as people are still logging on here, and then we will get started. So stay tuned. We'll get going in just a minute. All right, everybody. We still have some folks logging on, but let's go ahead in the interest of time and get started here. First off, I want to thank everybody for getting on the call with us today. Going to cover a lot of good information. We've got myself, Jess Riley, Director of Sales here at IAMS on the life side. We have Paul Huber, also from Allianz Life here. It's kind of a follow-up to a webinar we did a couple of weeks ago. We did cover the Allianz IUL product. Today, we're going to talk about that a little further, but also more focus in on handling objections, specifically in the IUL space. So there's going to be a lot of good information we'll cover here. Again, I appreciate you all jumping on board, and we're going to go ahead and get started, kind of do some housekeeping stuff here, and then I will turn it over to Paul. So let's talk about IAMS and some of the things we have going on. For the folks that are licensed with us and have been on our webinars, this will look fairly familiar to you. Again, a lot of new agents jumping on, so we want to make sure everybody is aware of all the things we have to offer here. So first off, we'll just start by going through the new producer builders. So if you are a new agent to IAMS or considering becoming licensed with IAMS, I want to make sure you're aware of some of the things we do to help get you jump started. So as you can see here at different levels, there are different things that we offer. These are based on annuity production, what you see here. If you're looking at life insurance production, it would basically be 1/10. So at the $100,000 level or the $10,000 target level, if you're a new agent with us, you would have access to all the things you see there, including a 1,500-piece mailer or a new iPad or cash. You get to choose one of these options when you hit that level. If you decide to defer and wait until you get to the $250,000 level or the $25,000 of target, that's when we can offer a 3,000-piece mailer, $2,000 in marketing reimbursement money, a Visa gift card worth $1,500, or some newspaper ad, marketing collateral, etc. We get up to the $500,000 mark or the $50,000 of target premium. Now we're jumping up into a 5,000-piece mailer. Or a 4,000 postcard mailing and a Dave Pimper seminar, which we can talk more in depth about, a billboard ad presentation, email distribution or full website overhaul, or a package that would take you to the Ritz-Carlton. We jump up to the $750,000 or $75,000 of target level. Again, you can see you can be a radio host, start your own radio program using Retirement Boss Radio. Or you can get a 4,500 lead credit. These are digital annuity leads, 2 Social Security seminars, or 1 social media campaign along with full video. And then if we get to the $1 million level or the 100,000 of target, you can see we can do things like a full dinner workshop with 8,000-piece mailers, The core story brand builder, get published in major news outlets, 8 to 10 preset annuity appointments that are all qualified, or 3 videos, consumer brochures, and articles. So these are all things, as again, a new agent to us, kind of are designed to help get you jump started with IAMS. Second thing we want to talk about in regards to the business builders are ways that we pay our advisors extra. So one of the things is we always appreciate referrals, and so we do have a referral program. It's a one-time $50 bonus for any agent you refer to us that becomes licensed. They also get another $100 bonus when they write their first piece of business, and then you can make thousands of dollars more as they write additional business. So you can see we actually pay some basis points to you based on your referred producer's production. So this is a really cool deal. We certainly encourage you to tell your friends and peers about us and the ways that we can help our advisors. And then, of course, we do have a marketing reimbursement program. So every $100,000 of FIA premium, you get $100 in your marketing account. If you write $100,000 of single premium life, that's going to be $200 in your marketing account. Or if you write $10,000 in target life premium, that would get you $200 in that account. And you can use those monies in a variety of ways to help grow your business. And those things we can always talk to your sales directors about as well. One of the big things, of course, about IAMS is our back office support. We have hung our hat on our service being the best in the industry for, about 35 years at this point. We do have the best back office in the industry on both the annuity and life insurance side of the house. Those of you working with us have experienced that. Those of you that may be new to us would certainly be a good reason to give us a shot here. We will not be outdone when it comes to service and back office support. We help you work smarter, not harder, right? We've all heard that a million times, but it's true. That is exactly what we do for our advisors. So we do that in a lot of ways. As you can see on these bullets, we have a ton of business building tools and resources out there for you. Of course, we're helping with all of the case design that you want. We have access to a lot of different software programs that we'll talk about here shortly as well. Our website has forms and digital tools right at your fingertips, quotes, etc. So, and all of the paperless needs that you have, the e-apps, both on the life and annuity side, are available. And we kind of keep everything housed in our website, so you have a one-stop shop. So speaking of that, Firelight is something that's very, very big with us. This is the electronic application process for most of our annuity carriers. Now, we're going to be talking life insurance today. Some of the life insurance carriers like Allianz do use Firelight. Some of the others use iPipeline, which can be accessed through our website, so keep that in mind. Firelight, though, will be primarily available for the annuity side. You can kind of see a list of the carriers that we do have currently on the Firelight platform, and we'll always be adding more. As you can see, we've got a coming soon list there as well. But we really encourage you to utilize that. It's cutting down on mistakes on the applications and getting this business in clean and issued more quickly. So certainly encourage you to talk to your sales directors about the Firelight process. I would also like to take a second to hit on the creative marketing solutions. We have a great creative department here that helps in a variety of ways. And so you can see here, we've got turnkey solutions, everything from flyers and newsletters, postcards that are ready to go, just need to be customized with your info. We do have agency solutions, so fully customizable branding materials, whether that be helping with logo design, creating business cards, brochures, stationery, etc. And then, of course, the creative team also is very, very well versed in the digital solutions side of things. So we do things like personal website development, several different digital marketing strategies, social media marketing, etc., online newsletters. So we've got a great creative team. Want to make sure you're aware of all they are able to do for you guys. The other thing I mentioned earlier is our website. I'm surprised every week that a lot of our advisors aren't aware of all the tools that we have out there, and we need to do a better job of getting that information to you. But our website houses a lot of great tools on here. So you can run your term and universal life quotes quickly through IGO. We have all of our forms online. We have all of our electronic applications out there available through the site. We have access to Annuity Rate Watch for all of our annuity producers there. And we have access to all of our life insurance products as well as our long-term care and single premium product grids. And one other thing that we do have is a sales resource library. A lot of advisors are not aware this is out there. This thing has a ton of information available for you guys, whether it be pre-approach letters, concept pieces, fully customizable client PowerPoints. I definitely would encourage you guys to check that out. That is under the sales resource library on our website. We do also have one of the best software platforms in the industry as far as analyzing one's retirement, hence the name. This is a great program. I know most of you are familiar with this, but really this program does a great job of taking a client's retirement plan out of their head and putting it to the test rather. A lot of times we're able to identify some opportunities for some planning here. A lot of times we're able to help clients realize that they've got some shortfalls or some changes that need to be made that may not be aware of prior. So this is a great software platform available for you guys as well. I do also want to mention that we do have a wealth management department. This is a great opportunity for financial advisors to help increase their revenue, help their client retention, and strengthen those relationships. So make sure and ask your sales directors or anyone in the IAMS family about the wealth management team and how they can assist your business. And then last but certainly not least is the Top Producer Summit. We're going to be going on a Mediterranean cruise here. As you can see, this is a very, very exciting trip. We're really excited about where we're able to take you guys and all the stops we're going to be able to see. One thing I will tell you, if you'll notice that qualification period, we do make those an 18-month qualification. We want lots of advisors to qualify and go on this trip with us. A lot of IMOs will restrict that to a year. We like to make that an 18-month target for you guys to hit. It takes $4.5 million of annuity production, indexed annuity production to qualify, or equivalent life production, and your sales directors can talk to you about that. But as you can see, we're going to some great stops. We're going to kick off in Rome, and we're going to end up in Venice. So great opportunity. We're really excited to put that out there for you guys. And if you have any questions about this, please make sure and ask your sales directors. And then also, I want to make sure you guys know that we are on Facebook and LinkedIn, so make sure and follow us and like us in these areas so you can see all the updates that we have going on for you. Okay. So with that being said, we are through with the IAMS commercial. I do want to bring on Mr. Paul Huber from Allianz, and we're going to get into the meat of this deal and talk about overcoming objections in the IUL space. And again, Paul, I'm going to turn it over to you right now.
All right, thanks, Jess. I appreciate it. And while we're making the always clumsy show my screen transfer here, what are we showing? You're seeing my slide there?
Yep, we got you. Overcoming common client objections. We got you.
Perfect. I never know if you're seeing that or my son holding a bass on my desktop behind me. So I think the most important thing is for you guys to acknowledge how much fun it would be to have, Paul from Allianz on that cruise with you. So we really need to start focusing on those IUL sales with Allianz to justify me being there. Definitely fun to out with and love to buy drinks for agents. So let's see what we can do to all meet in meet in Rome. I think that sounds like a plan, Jess. What do you think?
Hey, I'm all for it. I'd love to have you along with us, Paul. I think that's a good idea.
Awesome. So let's get started talking about overcoming objections here. And again, this is really, you guys know how to get in front of clients. You've seen everything Jess has talked about, how to help you with leads, everything else. But what happens when you have objections? When they ask questions, where do you go? Really, Allianz has spent a lot of time over the past 2 decades that I've worked with them in developing tools and really having conversations to answer those questions. We try to be as transparent as possible when it comes to talking about how the product works and what makes sense. So, as we look at the Life Pro Plus Advantage, this is what we spent a lot of time with a couple of weeks ago, going through talking about where it makes sense from protection from a life insurance standpoint, talking about the accumulation potentials and the flexibility, whether it's taking out those tax-free loans or using living advantages on the policies, right? So that's kind of the basics of why we're choosing IUL in the first place for your customers. So let's jump into some of these questions, and we'll have, I think, about a dozen of them that we go through that I think you'll typically hear and come up, whether your client's asking every one of them, or maybe it's stuck on one or two or three. You know, they go out to the internet, they read the Dave Ramsey's and the Susie Ormans, and they come back with these, well, I don't think IUL or permanent life insurance is right. So here's the big one. What if my situation changes? I can't pay the premiums, I need change in coverage, more death benefit, less death benefit. How does it work? What do we have access to? This is where IUL can be better than some of the other coverages out there, right? Whether we're talking about term coverage, which is short term and not very flexible, or talking about whole life, right? Which is also very inflexible. They're both good for their specific purposes, but IUL was designed to have flexible premiums, giving you access to that cash value whenever you need it. You have the living advantages and being able to change beneficiaries and move, you know, as your needs change. We looked back a few years ago on my team specifically, and we had about 20 or so members on the team. And over the year that we looked at, out of the 20 members, I think we had something like 3 marriages, 7 kids, 2 deaths, and a divorce go on in this time span, right? So your clients are having changes, whether they're adding people to the family, removing people to the family, that sort of thing. Jumping back to flexibility of premium, this is where setting up the policy correctly, doing things like maximum cash value with minimum death benefit, using death benefit option B a lot of times gives you the ability to have a bigger range of premium. So you can pay minimum premium or sometimes up to 3 or 4 times that for maximum premium. And if you start out with that maximum 4 times, that gives a little buffer if things like COVID happens, where all of a sudden your client's out of a job or not at work or has somebody sick in the family. They can fall back and sometimes access that policy, sometimes to shut down premiums and make changes. Now, if you're selling it the opposite way and you're going for highest target, low, and most death benefit, you're not going to have the same flexibility, and you might have to do things like reducing death benefit to reduce some of those fees and charges in that policy. Why are there guaranteed and non-guaranteed ledgers? You know, this is something that you look at, and a lot of times as we're going through and talking about policy illustrations, this is something that the insurance regulators make us show. You know, that means we have to show the good with the bad. And frankly, as we talk a little bit more, get into AG 49, the good has definitely been watered down quite a bit, but we still have, you know, those worst case situations. So what does that mean? I try to encourage you, don't shy away. Don't try to skip over and gloss over the guaranteed ledger, because I think if you actually explain what it is, you shouldn't have to hide from it. So take a look at this ledger. Now, keep in mind, I don't think that my marketing team created the most effective overfunded IUL illustration out there. I think this is kind of a paying slightly over target or minimum premium, $250,000 on a male 45-year-old, paying $5,000 a year. Well, let's fast forward 10 years. In the guaranteed scenario, they've put in $50,000. Their cash value is just above $25,000 and change. Now, this is where you're going to tell me, Paul, this looks terrible. My customer won't take this. They want guarantees. Well, let's talk about what happens in this situation. Year 1 is locked in guaranteed, right? We know that won't change. However, year 2 assumes that your carrier, in this case, Allianz, raises all your fees, charges, and costs as high as we possibly can. So that means your cost of insurance doubles, if not triples in some cases, to where it was. This means that you have 0 return. And with Allianz, you actually get 0.1% guarantee if you get in this guaranteed assumption. So you get the greater of what it's actually doing with real costs and charges, or highest fees and charges at 0.1%. So 10 years down the road, this is assuming Allianz has done everything it could to raise fees, charges, and costs, and you've also got 0 in terms of index gains or returns every single year, 0, 0, 0, 0. Now, 1, shame on you as an agent if you're in a policy in a carrier and you've gone for 10 straight years with no gains. One, think of where the market's going to be, right? We've never had 10 straight years. You might see two. Once, I think we've hit 3 years of zero returns, but typically after one of those zeros, you come back with a double-digit return. Highly unlikely. Again, talking about shame on you as an agent, I encourage policy reviews. So every year you should be meeting with your customer, talking to them about what's right, what's changed. And frankly, if you were with a carrier that raised their fees and charges as high as they could in year 2, 3, 4, 5, 6, I would be looking to go, let's get the heck out of this. What can we change? Something happened. Now, again, fast forward 10 years, I think if we get to a point where the market has been down for 10 straight years, you're not worried about your insurance policy at this point. Frankly, you have half of your money. So if we figure you've had $250,000 of death benefit for 10 years, you've had a policy. Now, I won't pretend that 250 would have cost you 25,000. That's not true. But at the same time, you have half of your money. You've had death benefit for 10 years. And again, what other investments do you have, and what are those going to look like after 10 straight negative years in the market? I would be willing to bet that they don't have half of their value still in them and providing that death benefit. So again, when you paint the doomsday scenario and what it would really take for this policy to perform at the guaranteed worst case scenario, I think your client is going to understand that, you know what, this really is not likely to happen. Sure, the first 3 years may look at the guaranteed situation, right? We could hit that 2008, 2009, 2010 kind of run, something like that, or you definitely could hit that, but 10 straight years is not likely at all. Fast forward and look at the actual, current assumption letter numbers. Now this is looking at roughly a 6% return, and we'll get into some of those details here shortly on how we can justify those numbers and what we can show your customers to justify it. But now, again, this is not a max funded situation. You're typically looking at a break-even point in those max funded situations around years 5, 6, 7. In this case, we have 50,000. It looks like we're not hitting that break-even point, until we hit year 14, 15, thereabouts. So this is going to give them, somewhere in between. This is what they can expect. And again, as we talk about AG 49 and what has happened, I think we can understand that even with the non-guaranteed scenarios now, you're going to feel that you're under-promising and over-delivering when you have those policy reviews. What happens to my policy if Allianz goes out of business, right? Well, one, I hope that doesn't happen. Now, looking at our carrier itself, we've been around for, I think, going on now almost 130 years as an insurance carrier. Our parent in Munich, Germany, depending on the day, are somewhere between number 1 and 2 in the largest insurance carriers in the world. One of the things that we find important are reserves. In Germany is very conservative. Not only do we have regulations from the federal government about what we need to keep for our promises. So if we promise you give us X, $1, we need to have so much of that dollar available on hand as cash to pay it out. And making these numbers up slightly, but they are somewhat around these, where they might say that for every dollar you have, you need to have $100, $1.20 or $1.30 in your reserves to meet your obligations. Allianz, as required by Germany, and kind of being that fiscally financial conservative, looks for us to typically have somewhere in the neighborhood of $1.75, $1.85. That's been as high as almost $2 for every dollar we have promised out there. So we are very careful. And if you look, life insurance carriers in general typically are some of the most conservative investors out there when we talk about portfolios. You look at reinsurance. We have a number of reinsurers that we partner with to make sure that we're not taking on too much risk and too much liability. We have the ability to pass on some of that risk and obligation onto them, which takes a little bit of load off our back when it comes to what if a pandemic comes and you have a bunch of some set group of people, then all of a sudden you're hit with a bunch of death benefit payouts. And then you look at the guaranteed association membership. This is kind of the all for one for all mentality. You look at some of those carriers like Executive Life or Conseco that went out of business. All the other carriers have to chip in, pick up the slack, and really help them make good on those promises that are out there. So your clients aren't going to be left hanging. they might not get exactly what they had promised to them when they sold the policy, but it's not just going to go away if a company declares bankruptcy and goes away. Again, though, looking at where Allianz is and how we're set, definitely not in any position that we need to worry about that. Looking at our ratings, some of the best in the life insurance industry, you can see from both AM Best, S&P, and Moody's, some of the highest ratings possibly that you can get. Another thing that's important is talking about Allianz SE, our parent. Look back in 2008, 2009, when we had kind of the crash. You saw that some rules changed. A lot of carriers lost some of their ratings and had decreases because the reserve requirements went up and carriers needed to have more cash on hand. They didn't have enough cash on hand. They weren't able to meet their ratings, so you saw decreases in all their ratings. We were one of the only insurance carriers that did not see any decreases. The big reason why is Germany said you will not fail, you will not lose any of your ratings. They infused over $1 billion into Allianz. North America, propping up our ratings. We returned that 2 to 3 times fold in dividends paid back to them. That's one of the advantages. They choose to keep a big chunk of the cash at the SC Germany level. So as they're looking at the 70 plus companies that they work with and run all over several countries, as they need cash, as things change in their specific market, they're able to infuse them with capital and make sure that they stay right where they need to be. So having strong support from our parents in Germany is a big thing. What can change on my policy outcomes? So this is a good question. We're going to talk in the slide specifically about what can change for the policy. I think something that we didn't add in this that I think would be very important is, what is the client doing, right? When we set up these illustrations, there's really 3 things that can happen to make these go bad. You can see rate and market conditions, right? That's not really controlled by anybody other than just what happens. We have the fees and the expenses, which is controlled by the carrier and market conditions, right? How do we respond? But also just as important is, how do the clients, the consumer, fund their policy? If you're setting them up to pay $10,000 a year for 10 years, and in year 2 they choose to fund less, obviously they are going to run into issues in terms of this policy not performing as expected. So setting the proper expectations of, here's where you should be, here's what you're going to do. Now again, these can be flexible and you can set them up so they do have the ability to change and maybe not meet the plans. But that's why having those annual reviews are important, so you can set proper expectations if they're not meeting their obligations that we set forth early on when you sold these policies. So let's talk about different market factors. So here we're looking at, we see general investments go up. So that means what Allianz is putting their investments into, the portfolio rate is going up. A good barometer of this is that 10-year treasury, right? We're able to invest in things similar to the 10-year treasury. That's determining what our yield is. If that number keeps going up, now keep in mind, we have one portfolio for all of our life business, which means policies sold 15 years ago versus today are all going together in one bucket. This is different from the annuity side. The annuity side will wall off their portfolio depending on market changes. So if rates jumped up 2 points tomorrow, that's fantastic. The annuity side would wall it off. They would raise all the caps and rates on their new product and go forward. For us, we still have all that old business that is going to take some time for new money to go on at the new rates and bring that whole portfolio up. So think of it this way. It's going to be slow going up and it's going to be slow going down. Well, the life insurance has had the benefit of this. As interest rates have decreased, as you're looking at the past 10 years, our portfolio has felt stress along with every other carrier. And that's why you've seen a very slow decline on rates and caps. And as rates go up, which, it was nice, we started the year or just at the end of last year below that sub 1% in the 10-year treasury. Now we're above that. If things level off and keep going up, that portfolio is going to change and you're going to see caps and par rates slowly start to increase. General accounts going down, like I said in that last comment, as those rates go down, you will see caps and participation rates decrease. Looking at the 1-year risk-free interest rate, that kind of gets tied to volatility and cost of the options. So as that rate goes up, you'll see caps will start to go down. We were in that situation, about 18 months ago. We saw actually a bump in interest rates, but we also saw a spike in that 1-year rate, which means the costs and charges for our options went up dramatically. So there wasn't as big a bump in those caps. Now, if that rate drops down on the 1-year risk rate, that means the costs drop down. Therefore, we are able to increase caps. Looking at volatility, volatility goes up. You typically see some downward pressure towards caps. Volatility goes down, you're going to see caps increase. Now, being that Allianz does have a number of different allocation choices, one of them that kind of works inversely to what I just said is our monthly sum. As volatility goes up in that index, those rates actually get cheaper, therefore you have more upside. So again, having a lot of different choices and flexibility means that as a lot of these different markets go up, go down, and change, you're going to have allocation choices to allow you to get the best for what's going on. And diversity, I think, is also key when talking about allocation changes. Let's talk about expenses and charges, because we all know these life policies do have upfront charges that are pretty significant. Customers are going to balk at first if they're comparing it to something else with the higher fees, charges, and costs. The first one that you have coming out is going to be your expense charges, right? This is essentially a premium tax that's coming in. In the beginning, this was pretty easy to overcome because a big chunk of this goes to pay for state taxes that carriers have to pay that's being passed on. Now, as some of the different mechanics internally in the policy have changed, some of those charges have gone up, and now this is actually can be a profit source for the carrier. 14%. We don't have any states out there that are charging nearly that amount for that. But you're looking at the premium charge. You see 8% in the first 9 years. This is up to the max non-MEC premium. In years 10 going forward, it's going to be that 4%. If you're doing large 1035s or moving over large lump sums for MECs, that's where you see once you get past that 7-pay number, you see that surcharge get put on for that 14%. You also have that surrender charge, right? 12 years decreasing based on their age, gender, risk class. You're not going to see a lot of cash value in those early years, but that does start to decrease as you go forward. Looking at the other big charges, the 2/3 of the charges on the policy are going to be made up from the expense charge and the cost of insurance charge. Now, cost of insurance is pretty straightforward, right? That's looking at the client's mortality based on the underwriting, their age, their gender, risk class, so forth, and we charge slightly more than what the charges say it should be to make a little bit of profit. Now, the expense charge is a harder one to discuss, right? Truly, this is the cost of doing business. This is really your commission charge that's going on. And rather than charging them for the commissions up front, it's spread out over, I believe, 12 years. So when you're looking at it, I would explain it to them as, listen, it costs money for these carriers to put these policies out, everything from your brochures to me, your wholesaler, to Jess and his team. This goes into all of that charge and cost of doing business and getting everybody paid. Now, the good news is that if we design it properly, that expense charge does drop off later on. And if we set this up with minimum death benefit, maximum cash value, we can significantly reduce that cost of insurance, meaning that these policies, as you get into those later years where you may see 15% charges upfront for the first 2-3 years, as you get later in the policy, that number drops down to more of a 1% on average cost of doing business, which is in line with your 401ks or your managed money that you're typically working with. That $90 policy charge, that's just sending out statements, keeping people to answer the phones, that sort of thing. And then that asset-based charge, that gets into the index-specific choices. We do have some options out there available for your customers that if they want a little bit more upside and they're willing to pay for it, we can get them more upside. Again, that's a charge that they can move in and out of any given year. How do you know which bonus is right? I just talked a little bit about choosing which bonus and which index allocation. This is where that falls into. You can see that we have, I think, almost 16 allocation choices. I try to break it down less thinking about the 16 allocation choices. Think of it as 4. You have the BUDB, the Bloomberg U.S. Dynamic Balanced Index. the PIMCO index, the blended index, and the S&P 500. Those are your 4 index choices that you can choose from. Now, frankly, you'll see our illustrations default to the Bloomberg and the PIMCO. Those are our top choices, mostly because of what we'll talk about in a minute, that index lock feature that we have. But we do have that blended, and we do have that S&P. With that, you can choose 4 different bonus options, one for each one of those. You have the standard, no bonus, a little bit higher return, higher cap, higher par rate, but you're not getting any bonus on it. You have the bonus and the select, which are non-guaranteed multiplier of 15 or 40%, depending on which one you go with. These are going to give you the most bang for your buck. Now, you can see on that select, you have that 1% asset base fee. This is going to buy you a bigger bonus. So if the market does 10, you're getting 40% on top of that, meaning you're actually getting 14% minus the 1% asset base charge. Same thing with that bonus. If you did 10, you're getting actually 11.5, but there's no charge for using that. Now, with AG 49 happening in December, we are no longer allowed to illustrate these 2 bonus options, which we'll get into in a minute. But you do have the ability to use them. The classic bonus is a 90 basis point guaranteed flat rate bonus that does meet post AG 49 rules. There is no charge to using this. It is going to be illustrated. So if you're running an illustration at 6, you're actually running it at 6.9%. Now, again, it's nice because it's guaranteed. You know that you have that 90 basis points happening every year, but it's going to be limited. If you do see those double-digit returns, you're not going to be able to get those bigger multipliers. So we'll get into more of those details. Which one is right for you? The classic is there for somebody who, maybe wants to avoid a 0. They're okay with the 90 basis points. They don't want to pay for anything else. If they believe that the market is going to do 4% or greater, mathematically speaking, the bonus or the select index is going to outperform the classic bonus typically. So more upside, more potential with that. If they're willing to pay more and they're okay with having, instead of that 0's your hero, having that 1%, you can go with that select bonus. We're seeing a lot of clients choose that. They do like that 40% multiplier. Just know that they will see that 1% come out. Again, these allocations and these bonuses can be mixed and matched and changed any given year. So you do have the utmost flexibility. And then if you want to just keep it simple and clean, you have the ability to use that standard no bonus option on any of them. So then the question becomes, why does the conservative classic bonus illustrate better than that 40% bonus? Well, it's like I just said, with AG 49, the regulators came out and they said no more multiplier bonuses. You're not going to be able to illustrate it. We're not going to let you show these non-guaranteed bonuses. So therefore, the illustrations are going to perform worse because they're not showing that bonus. The other part of this was all illustrations had to drop the arbitrage between what is assumed for the return and what the loan balance of the loan rate is. So with us, it's 5% guaranteed loan rate, index rate. If you were running 6%, you would have to show a 5% return on the loans. Now we've reduced that down to a 50 basis point reduction. That's the max arbitrage you can show. So you would see that from last year to this year, most illustrations have gone down on their assumptions. This is why we came up with the Allianz Showcase. This is a tool that will help you. Don't think of it as an illustration. Think of it as a interactive sales tool that can give examples of how these policies perform in real life versus the illustrations, which can't show the bonuses. So on the left side here, this is an illustration. If you were going out, you were running a 42-year-old male, best risk class, paying $8,000 a year for 23 years, doing the B to A switch, max death, minimum death benefit, maximum cash, and then taking out income at year 20. So 62, you're taking out income. So you can see the standard bonus would kick out income 20 years down the road of 21,000. The classic bonus looks the best at 31,000 and change. The 15% bonus comes in at 22,000, and then you're down to 21,000 for that select multiplier. Remember, it's less because you're paying that 1% charge, so they're getting hit with those costs in that policy. What the showcase allows you to do is pick a handful of ages like 45, 50, 55, and also select premium 10,000, 20,000, 25, 50,000, and then pick the premium duration you want, 10 years, 20 years, so on. So I think altogether there's about 39 different scenarios that can be run. Again, that's key. We don't want to have too many scenarios. This is not an illustration tool. This turns into an actual PDF sales piece that shows these numbers. Because it's a sales piece, we're not restricted to the 6% or some of the AG 49 limits on rates. So we're using a 6.5% for all of them. So again, now look at those same numbers. If we take a 45-year-old paying $10,000 a year for 20 years, again, very similar to our actual client, we can see that the standard kicks out $30,000 of income. The classic kicks out $40,000 and a little bit of change. Now you see the multiplier 15% bonus kicking out slightly higher than that classic bonus. And if you actually hit more of our historical numbers, getting up to 7%, obviously that's going to perform even better. The closer we hang out to that 6, 6.5, they're going to be pretty equal. But you can see that the select 40% with that 1% multiplier is now kicking out $7,000 more per year than the other options. So again, mathematically, it makes the most sense. Now, again, with that, each client is different. I would say go with what works for them and what makes sense for them. I don't push that bonus on anybody, but if they do buy into the math is going to give them more upside, even though those illustrations are not going to show it for them. How reasonable is that illustrated rate? When AG 49 came around in 2015, the first time, the head of the ACLI, who was in charge of that regulation, was actually the Minnesota insurance commissioner. So he came over to Allianz and said, show me what's going on. You guys are the index leader. Tell me what your secret is or what's working, and is this true or not? The whole life carriers wanted us to use our fixed interest rate as the maximum interest rate allowable. And we went back, pulled all the policies and looking at all the data, and that's what you're seeing here, pulling back statements from every single customer we had. And what we found is it held pretty true to what you're seeing here. The average fixed account for our customers over the past decade and a half has been a little over 4%, 4.21%. The actual return our customers have seen, actual index credits on their policies, is just shy of 7%. Now, what does that mean? That means that if they're going into something like an index policy, they could get 4.21 and just say, give me that return. They don't want that. They're looking for more upside. It's risk premium is the difference between the fixed rate and the indexed rate. And if it wasn't there, why would a customer go into an index account if they couldn't actually see more? So looking at this chart, and this is actually a client approved sales piece that we do have out there. I might have sent it out after the last meeting we had. This is taking every customer from 2006 and showing their historical return. This isn't what they did in 2006. This is saying customers who bought policies in 2006 have seen over, if you draw the dotted line down below, over a 7% return each year from 2006 to 2020. Look at customers that bought their policy in 2009. They are experiencing over an 8.5% return year over year as an average of when they started. Again, same thing with 2016. So this is looking at all those years together, not just what did each policy do in the particular year. No, this is they bought in 2006. What did they do in 2007, 2008, 2009? Then we looked at 2007, all those policies from January to December. So again, a pretty powerful piece to show that, yes, our customers as a whole are experiencing a 7% return. So when you're running these illustrations at 6% or 6.15, you can feel pretty confident that we are under promising and hopefully you'll see over delivering. Now that doesn't mean that next year absolutely it's going to be better. You can always have zeros any given year, but as a whole, year over year, and looking at the long-term picture of this, I think your clients are going to be happy when we under promise and over deliver for them on those returns. Another thing we can do is run a backcasting report. This is tied to our illustration software. You can go out to the backcasting tool. You can enter in either our allocations and the par rates and caps, or another carrier's rates. and it will show you the likelihood. So looking at the year past performance, what's the likelihood of this getting a 0 in any given year? You look at, say, the S&P 500, you're looking at 1 out of 4 years, typically, the S&P coming back with a 0 return. What's the likelihood that you get a return greater than 6% in your illustrated rate? So in this scenario that they ran, you can see that the blend that they're using is coming back with a likelihood of 0, 7% of the time, so less than 1 out of 10 years. However, you're looking at almost half of the time it producing a greater than 6% return. So this will allow you to really dive in and find out what is the probability, what's the right rate for your customer, what do they feel confident in doing. Is it something like getting that rate or likelihood up to a lot of times you'll see it currently at 80, 90, 95%. If you dropped it down to 5.5 for an assumed rate, you probably would be at a 100% likelihood in any 15-year scenario of getting that return. So knowing that you have the ability to run this yourself, you can move it, caps go up, go down, you can make those changes, you can compare products, again, because we allow you to enter other carriers' caps and look at multiple anniversary dates. What kind of protection do we have against losing money? Looking at annual reset, this is really 101, right? But knowing that when the market goes up, you have the ability to grab those gains. When the market goes down, your values are locked in. The difference between annuities and life is that life insurance does have that cost of insurance that's coming out every year. However, you're never going to lose money due to market loss. The one caveat here is if you are in that select index, you will lose that 1% because that's us paying more for your options, buying a little bit more to getting you that bigger bonus. But annual reset really helps protect that 0 is your hero. One of the things we've also introduced is our volatility controlled indexes. You heard me mention these earlier. Our BUDB, or Bloomberg US Dynamic Balanced Index, our PIMCO Tactical Balanced Index, both of these are volatility controlled indexes. We came out with these indexes to really help balance the rise and fall of caps. I mentioned that for the past decade, we've been in this decreasing cap market. And we've seen with these different indexes, it's going to give you more upside potential. By coming out with these volatility controlled indexes, as we get into these lower interest rate environments, your customer's not going to have to ride the highs and the lows with cap changes quite as much. That's not to say that your caps and par rates won't change, but as you do see dramatic swings in the S&P 500 and our blended index and some of those true annual point to points, it wasn't long ago that 10 plus years ago, you had carriers offering 15, 16, 17% annual point to point caps, and now they're down to 9 or 10. So looking at this, you still have uncapped upside, and you do have the ability to still get that 0%. How can we afford our indexes and our interest credits? This is another sales piece we have calling how does hedging work? And I think it's a really good example of what insurance carriers do. So if we take $1,000 of your client's money and we separate it into two parts, on that left side, you're going to see that roughly $950 of the $1,000 is going into our general portfolio. This is an extremely conservative investment portfolio made up of high-grade bonds, and again, very, very, very safe. Now, we know that in that portfolio that we can yield roughly 5% return, which means if we put $950 in it, at the end of the year, we're going to generate that 5% to get us back to $1,000. Now, at that point, we know that we now have that 0 for your customer, right? We know that even if the market goes down 5%, 10%, 50%, we put 95% of their money into something really, really safe that we knew was going to return us that 5%, and their money is protected. Now, the magic comes with that other $50 when we go out and we hedge it and buy, the options with that. Here's where the Allianz difference comes in. All the other carriers are taking that $50 and they're going out to an investment bank. They're having them do the trading, them buying the options, and them managing that portfolio. Allianz does it ourselves. We do it in Minneapolis here. We manage that portfolio, and because we do it ourselves, we are able to get better spreads, better rates, and save a little bit of money on top of come up with our own indexes and our own strategies that make sense. Now, in taking that $50, we go out and we buy that promise, which means that if the market goes up 10%, we were able to take that $50 and grow that to $100. So now we can make that $1,000, $100 or $1,100 going forward the next year. If the investment goes bad, it comes back at zero. Well, that $50 is now worthless. We fall back on the $1,000 on the left-hand side. Again, this is extremely simplified on how it works. It doesn't talk about the fees, other fees, charges, and costs. This is just the hedging example of how we keep it safe, how your client is not exposed to extreme market loss, and how we have the ability to give them that upside. If you're looking at something like the BUDB or the PIMCO that are uncapped, all it means that we're able to, because of that volatility control, we're able to do more with it. We're able to take that $50 and promise that, yes, if the market does go up 20%, we can turn 50 into 200 to keep those obligations. And the one thing I always point out, kind of interesting, our hedging desk is paid on basically a net sum zero gain, which means their bonuses are tied to their performance. The closer they get to coming into their actual promises of zero gain, the better. So if they make too much money, they're actually penalized from a bonus standpoint, because that means that either A, they were too risky, or B, they could have given the client more upside through more cap. On the flip side, if they have not enough money, then obviously that's a bad thing. The grand scheme of things, we're working with over $100 billion with a B dollars, in our portfolio when you look at our annuity side and our life side. So we have a large scale to do this. Some other advantages that we talked about: static hedging. That's what the other carriers are doing, passing on the risk, versus dynamic. We are investing daily. We're making trades and options calls daily. Your policy here at Allianz has a unique anniversary date, as opposed to once a month like some of the other carriers. Again, we're not reliant on the investment banks. Our high volume of trade affords us a lot of ability. We get very innovative with the different allocation choices that we have. And again, no need for sweep dates, because we are doing it daily. Therefore, every policy is going to be unique and different. How do we avoid a zero? Looking at our rate lock feature, we are seeing customers right now lock in 15 to 20% currently, policies that were taken out 3 months, 6 months ago, because the market has done well. Having the ability to track the values online, looking at how it's performing, and it's the PIMCO and the BUDB index specifically, the ER versions have that rate lock feature. We're working on adding an auto lock feature that's coming up in May. We'll talk more about probably the next time we get together. And also we're looking at, over the next year, adding that rate lock feature to more of an S&P type index and our blended index. So we're hoping that in the next year or two, all of our policies are going to have not only this rate lock feature, but all the indexes have the rate lock feature. And I think also another cool thing to point out is we've gone over the past year and added the rate lock feature and these new BUDB and PIMCO indexes to all of our Life Pro Plus business, which goes back to 2011. And over the next year, we're going to be adding it to all of our Gendex products and the Survivor products, which go back to 2005 when we really came out with our new index portfolio. So all of our customers getting taken care of, getting those features added to the policy, which I think is great. We're also going to be coming out with more sales pieces. How do I know when to lock? When is it right? Clients can go out to the website. Agents can look at the website. There's actually a really simple tool that allows you to review your policies. If you wanted to search and say, hey, pull up anything that has a 10% return or greater currently, it can do that, or 3% or 5%, whatever that number is. So if you want to reach out and have a conversation with your customer to say, hey, Jess, by the way, I pulled your policy up. You're at 12%. You got 6 months to go. Do you want to lock in now, or what do you think the market's going to do? They're going to have that power. Why to choose Allianz over the other carriers? Again, feeling confident in our strength, knowing that we have some of the best ratings out there. We're here for the long term. You can see 99% of our $136 billion portfolio consists of investment grade securities. Again, promise is a promise. We are not here to make a quick buck. We're here for the long haul. Relying on our risk management experience, we've been doing our hedging now for over 15 years. And then being part of that Allianz global family, like I said, one of the largest insurance companies in the world, number one or number two, depending on which day you happen to be in. So I know I'll kick it back over to Jess, probably pull up his team's phone number. So if you have any questions, I know we're showing at 5 minutes. I didn't leave much time for questions and comments, but I know his team can absolutely handle them. So I'll take a breath and pause. And Jess, is there any 1 or 2 questions that might have popped up you want to cover?
So yeah, I don't have any questions popping up here now, guys. But if you do have some, go ahead and plug them in here, and we can ask those as they come up. Also, we can certainly talk to the sales directors here afterwards if you have questions. The Allianz Fast team is a great resource as well. So if you guys have questions, let's pop them in now, and we'll give you guys a couple minutes to do so.
I will tell you guys that you see the AllianzLife.com. I never remember what is that / or / life sales tools. That is our website that is not password protected. So if you're not currently appointed with us or you don't want to look up your login, jump out there. We have a lot of our sales kits, a lot of the materials and the client pieces I talked about today are available on this tool. So if you want to get out there and look at them, you don't have to dig out your Allianz password to get there.
Yeah, absolutely. And there are a lot of great things out there, guys. I can tell you, obviously we get a lot of questions on indexing and how certain carriers can do certain things. I think Paul did a great job of showing why Allianz is kind of ahead of the pack in a lot of ways, specifically in their hedging, their ability to really offer the maximum gains there. And that index lock feature has got nothing but rave reviews from the advisors I work with that are using it. So one of the questions that just popped up here, Paul, is does Allianz have a term rider on your product?
Yes, we do have a term rider and also kind of a unique feature of that term rider. It's actually convertible. So you may choose not to convert it whatsoever, but you also may choose to use it to, a lot of younger clients that want to buy up coverage going forward. So you do have the ability to use it. I think you can go up to like 9 or 10 times the permanent coverage. So play around. It's in the illustration software. You can use that as you see fit.
Okay, thank you. I am going to go ahead and launch a couple of poll questions here, guys. Again, we always want to make sure that what we're doing here is valuable to you. So I'm going to go ahead and launch the first one. So you guys can go ahead and open that or answer that. I would greatly appreciate it. We'll give you a minute or two here. Still some votes coming in. I appreciate it. Okay, we're going to jump to our next poll question here. If I can figure out how to do it. Okay, our next poll question. Are you interested in getting appointed with Allianz Life? So got several answers coming in. We'll give it another few seconds here. All right, and last question. Would you like more information about the IAMS Producer Summit? Again, that is the big cruise that we are going on in 2022, starting in Rome and ending in Venice. I think this is probably one of the best agent incentive trips that I have seen out there. So certainly something we're very excited about. Give that another couple of seconds here. Okay. All right, everybody. I would like to again thank you all for getting on with us here today. If you do have questions or want to talk a little bit further about Allianz or the ways IAMS can help you, please give us a call. Our number here is 800-255-5055. Ask for any of the sales directors. I would again like to thank Paul Huber for jumping on with us today. Great information, Paul. We look forward to working with you further into this year. And we're really excited about the index lock feature and the ability to auto set that on the front end. So we'll be looking to hear more from everybody about that here in the very near future. Again, I'd like to thank everybody for joining, and we look forward to hearing from you all soon. Have a great day.